Welcome everybody to the Sphere Home Loans webinar with all things refinance with Mel and Rach. I'd like to start today by acknowledging the traditional owners of the land in which we meet today. I'd also like to pay my respects to the elders, both past and present. You will see with the webinar's format today that we've changed things a little bit. Not a lot of content for you to download visually. So we decided to ditch the PowerPoint and we're just going to have a chat. There'll still be the option to answer questions for us to be able to answer any of your questions as you go along. So please feel free to reach out and ask any questions as we go along with the webinar. The topics we're going to cover today are reprice or refinance, using equity, valuations, extending loan terms and consolidating debt, and also what to look for in a lender. So we have Mel from our team here today. Welcome, Mel.
Thanks, Rach.
Fun fact, Mel and I worked together at Westpac about 13 years ago. Mel's been a broker with Sphere for 6 years now, and she does more refinancing in our team than any other broker. So I thought she was the perfect person to come on today and talk to you about all things refinance. So welcome, Mel.
Thank you.
So why don't you start us off by telling us what's happening in the market at the moment?
Yeah, so at the moment, we're super busy refinancing clients, like changing people around for different reasons. Like most people are looking for ways to save money. A lot of people are sort of chasing rate, but ultimately majority of people are looking to do things with equity, save money, extract some cash.
Yeah.
So really interesting in refinancing, busiest time in refinancing that I've had in the last 6 years here with you.
Yeah, I think refinancing has been huge this year. We've done more refinance in contrast to purchases than we ever have before. And I think the biggest topic of 2023 has been affordability.
Yeah, 100%.
It's no secret we've had 13 rate rises so far. December, we didn't have one, luckily.
No.
But people are actually trying to find ways to make their life more affordable and to stay in property, which is really a different sort of market than we've been used to.
Yeah, absolutely. It's completely different to what it was 12 months ago, 2 years ago. It's very different.
So on the back of that, we're talking about we're talking about refinance. So everyone's reaching out and saying, I want to refinance, I need a better rate. So I thought we'd start off today by talking about one of the most, the biggest topic, which is, do I need to refinance? And what's the difference between a reprice and a refinance? So why don't we start with that? What is the difference?
Yeah, so refinancing would be making changes to your loan. So whether that is looking to borrow more money, extend your loan term, change the way that you repay your loan, get a better rate. So generally that would involve changing banks. Repricing, on the other hand, is when we're looking to get a better deal for you at the lender that you're currently at. And we do that for clients that are even not our clients yet.
Yeah.
So it's just a way to help save money, because sometimes we can't refinance clients.
Yeah, so the mortgage prison's been a big topic. So a reprice, you don't necessarily need to refinance to reprice. And I think a lot of people get stuck saying, oh, I want a better rate, I want to refinance. Your bank wants to keep your business. It's a lot cheaper for a bank to retain a client than it's going to be to go and get a new client. So we're finding more than ever, banks are actually matching the rates that we're taking them. So unless somebody's getting an equity release or extending out a loan term, why are we refinancing if we can just reprice?
Exactly. Yeah. Then there's got to be a benefit in the client for us to refinance them to another lender. It's not free to refinance. So it's really important that the purpose of why we're doing it is really clear.
Yeah, and I think the banks have caught on that it's cheaper to retain your customers, which is why those cashbacks aren't as prevalent as they were. There's a few lenders still doing them, but you'll notice all those big banks have pulled out those $2,000 and $4,000 cashbacks.
Yeah.
And that's because they're working on retaining business. So we've actually increased our pricing team from 1 full-time person to 3, and their job is just repricing loans all the time. So that's not a refinance.
No.
Now, the mortgage prison that people get talked about when they get stuck in there, explain what a mortgage prison is.
Yeah, so a mortgage prison is basically that you can no longer, under the current serviceability calculators, afford the mortgage that you have, which means that we can't move.
Most people can't.
Yeah, a lot of people can't. A lot of people on big incomes can't. And that's really quite surprising and confronting to a lot of clients.
Yeah. So when someone's in a mortgage prison and they want to get a better rate, if we can't reprice them in their current product with their current lender, are there any other options for them?
Yeah, we can absolutely look at the type of product like you just touched on. Like if we can't move banks for you, we can look at different types of product within the same lender that you have. We do have another option of a couple of lenders that we have at the moment. They've actually brought out a simple refinance where the serviceability rate is actually lower than the standard serviceability rate. So at the moment, the assessment rate is around at 9.5%, which is...
Oh, what's an assessment rate?
Yeah, so your assessment rate is the stress test, basically. So it's generally your rate plus 3%. And that is the standard rule of serviceability. So the new simple refinance process, they only add a 1% buffer to your stress test. So your 6.5 rate is tested at 7.5%. So for some clients, that means that we can actually refinance them. It's not available at all lenders, but it is a really good way for us to be able to move those clients where things are really tight with servicing, that we can move lenders and get them a better rate. And we can still get some cash out by doing that.
Yeah, great. So the assessment rate might be 9%, but I'm using a simple refinance product, and now the assessment rate is 7%.
Yeah.
7% is a big difference to 9% for
It's
affordability.
huge. Absolutely, especially if you've got a couple of mortgages. Like that's huge because you're carrying 3% on every single one of those mortgages.
Yeah, so people can, I guess if you're stuck in a mortgage prison, what we'd like you to know is maybe you don't need to refinance, maybe you just need to reprice. But if you do need to refinance, there's a whole lot of different options out there, and some of those are the simple refinance. And I guess a lot of things that people are refinancing for, though, isn't rate.
No.
Now, if you're refinancing not just for a cheaper rate, if you're refinancing to get equity out, or if you're refinancing, which a lot of people are doing at the moment, which is extending their loan terms out for affordability.
Absolutely.
You need to be able to do a full refinance for that, either with your bank or without. So tell me about, when you're doing a refinance for extending the loan term, I know that's something that we haven't done a lot of before these rates here, because we want people to pay their debt off, but we also want people to stay in their homes.
We do. So
tell me why people would refinance now to extend the loan term.
Yeah, so basically it just comes down to getting your repayments down as low as possible. When so many lenders are so similar with their rates, we're not going to be chasing rate for you, because if we're chasing rate at the same loan term, you're really not going to be saving anything in your repayments. But if we can extend your loan term back, so say you got your home loan 6 years ago, you got 24 years left on it. Now, if we were to refinance that loan and stretch it back out to 30 years, your repayments are going to be so much lower than what you're currently paying. And it's not ideal, but the aim of the game is to reduce your repayments and make, your budget so much more, easy to deal with everything going up.
Yeah. And we do want you to pay off your home loan as quickly as possible, but you also want to stay in your property. So I think a lot of people have approached us and said, well, we're going to downsize our home because we can't afford our mortgage anymore. And they're going to have stamp duty of buying a new property and then agents' fees of selling. And I think it's worthwhile to at least break it down and work out the scenario of extending out a loan term if that means that you can keep your home.
Absolutely. Yeah. It's really important to have that chat and look at all the different options that we can, we can look at for you.
And I know I can already hear someone saying in the comments, mortgage broker, they want us to have more debt, or they want us to not to pay off our loan quicker. When rates were 2%, we sat down with so many clients and saying, well, average rates of Australia are 5%. So why don't we set your repayments as if the rates were 5%, even though you're only paying 2%? Like, usually our goal is to get people to pay that debt off as quickly as we can. But I can't deny the conversations we're having at the moment aren't people looking to pay their loans off as quickly as possible. They're people that are having trouble holding, and we're looking at solutions.
Yeah.
So I'm not saying this to say everyone should extend their loan term out. I'm saying, well, let's look at all of the options and what's important to you, and we can at least give you those scenarios of affordability.
Yeah, absolutely. It's really important. And we can still show you what it looks like to pay your loan off at the same term that you had left. But, when you've not got enough money to be making your repayments on your home loan, we need to be looking at all those options.
Yeah. So I guess that's an important thing to cover off too. So if I decide to extend my loan term out from 20 to 30 years, Can I change that back?
Yeah, absolutely. Yeah. When rates go down or your income increases, when cash flow is a little bit better for you, absolutely. We can refinance the home loan. It doesn't have to change lenders. We can do it at the same lender, and we can redo it for the term that you had, or we just set your repayments again an accelerated rate to make sure you pay it off at the same loan term that you were looking to do in the first place.
Yeah, and Mel does a lot more refinances than I would, because she's got a client base that do a lot of moving, but I have a different kind of client base. My client base are a lot of multiple investors, and a lot of my client base, and a lot of them I've had for nearly 10 years now, can't refinance. They've got multiple properties.
Yeah.
They've got maybe a small mortgage and maybe 3 to 4 investment properties, and they cannot in any way service the debt that they've got on paper. And so we did a lot of work when rates were lower, knowing that rates were going up, going back and saying, well, while you can afford that now, let's extend those interest only terms out. Let's do all the things that you can now.
Yeah.
And I think a lot of my clients are saying, well, I might need to sell one property to be able to extend the interest only loans out, or I might need to pay principal and interest on my investment properties if they roll over. But I think in people with multiple investment properties are probably having the toughest time with refinancing. And I guess that's why it's so important to make sure when you do have the income, whether it be I'm going to be going on maternity leave, or I'm going to be changing job, or I'm going to be doing something different, to make sure you look at your lending before you do it.
Oh, absolutely. Yeah. And if you're wanting to become self-employed, like, come and see us first. Don't make those changes without having a chat with us, because there's things we can put in place now for you, or give you the plan of what needs to happen if those changes are going to happen.
Actually, you just said self-employed, and it made me think of what we were talking about earlier. Tell me the big change for self-employed people, because that's amazing for anyone that's wanting to make a move.
Yeah, absolutely. So traditionally, self-employed clients were pretty much stuck from being able to do anything in terms of finance for 18 months to 2 years, where we would need at least 1 or 2 years tax returns. So one of our lenders has actually just bought out a policy for clients that own a company and pay themselves a wage, so a director's wage. They only have to pay themselves a wage for 6 months, and there's no limitation on the age of the registration of the ABN for that company. Now, that means that that's gone from a traditional 18-month registration to
6 months.
6 months, yeah. So in the fine print, you've got to pay yourself for 6 months. So it means it's got to be registered for 6 months. But that's huge for clients.
It is huge. And I think if you're paying yourself a salary and you've got some complex financials, you can leave those complex financials out and just pay yourself that salary. That's a game changer. Those clients would traditionally have had to go to a low doc product, maybe a non-conforming lender with a higher rate. And it makes sense for them to be with a major bank at a lower rate.
Absolutely.
Rather than, oh, you're self-employed, so you have to pay more.
Exactly. Come and have a chat with us if that's going to happen, because we can show you to what sort of an income you actually need to be on to do the things you want to do, and make sure you set up properly from the very beginning.
Absolutely. Now, I just saw a question come up on the investment property. I'm going to answer that. Said, when do you expect the strict lending requirements to ease and make it easier for those with multiple properties to refinance? My personal opinion on this is that some of the things that are happening in the background are meant to be making it hard for investors. I don't think we're being encouraged to hold as many properties. And I think for first home buyers and people to get into the market, I think there's going to have to be some movement, and they do have to make it a little harder for people, especially when rates were so low. I mean, if people just keep getting properties because they're all cash neutral, things are happening in the economy that the capitalist in me goes, well, that's probably the right, not the right thing. But the socialist in me says, well, people should be able to have affordable houses. So to answer your question, I think that this is a very deliberate thing to slow investors, and I think that it isn't going to change in the short term. I mean, there are some lenders that are coming out and saying, well, we'll use interest only buffers at a lower rate and things like that, but it's still tough. And I've had to tell clients on really solid incomes that they can't hold the properties that they've got now. So I don't think it is going to change, at least in the next few years. I think they're definitely trying to put a squeeze on investors, and that's very deliberate.
Yeah. And, and that's very much rate driven as well. It is. So any future rate increases will have obviously a negative impact, as much as when the rates start dropping, then we'll start seeing it a bit easier to get more money. But that's, it's controlled by so many different factors. It's like the strings being pulled on the puppet, really.
Now, moving on to using equity, I would say most refinances that we're doing at the moment have some sort of cash out component. And generally that's for home improvements, buying shares, or for investment properties. But I guess to start, a lot of the questions that did come through are stuff about how do I use my equity, explain using equity. So before I go into that, before Mel goes into that, I'm going to explain just really basically what equity is. So equity is usable equity is the amount of equity of your home that's usable right now. So generally that's 80%. Now I know some banks will go to 90, 95, but we're just going to use 80% for simplicity. So if you've got a house that you've bought for 500,000 a few years ago and you borrowed 400%, you borrowed 400,000 on that property, you've essentially borrowed 80% of the value of the property. So you had no usable equity left. Let's jump forward a few years' time. That property is now worth 600,000. And you've paid your mortgage down to 380,000. Now, you don't just have 20,000 in usable equity for paying down that 20,000 because your value has gone up. So now your usable equity is 480,000 minus the mortgage that you've got, which is 380. So you've got 100,000 left in usable equity. And that was made up of two things: the rise in the value of your property and what you've already paid down from your mortgage. So I know I've got 100,000 usable equity. Mel, tell me how to get it.
Yeah, so basically for us, it would always start with us doing upfront valuations on properties across a range of multiple lenders, because the valuation will differ from one to another. We will not submit an application for a refinance or equity extraction with the hope that a valuation is going to come in high enough for us, because we want to know what we're dealing with up front. But in terms of...
Does that cost anything?
It's absolutely free. Yeah, not a cent. So to do it, obviously, if we're doing a refinance, and that might be we're extending loan term and we are getting some cash out to do other things, it would just be an increase in your borrowing from the lender. It could be a separate split on your home loan, just depending on what it is you're wanting to do. If you're looking to buy shares, or if you're looking to do renovations to your house, it would be, just depending on the situation, how it looks. But yeah, it's quite a simple process for us to do.
Yeah, great. So as long as I've got the usable equity, as long as I've got sufficient income to service the debt as well as sufficient equity, I can take that money out and use that as I want to.
Yes.
Not saying that everybody should, but if you want to, it's there to use.
It is, absolutely.
So if I come to you and I want to do let's say $100,000 renovation, I want to do a kitchen, a bathroom, and a deck. And I come to you and say, I want to borrow this money for a renovation. I don't have a fixed price contract yet, because we all know that builders are having some troubles giving fixed price contracts at the moment, especially with things happening in the building industries. How would I get that money out?
Yeah, so we would just do an equity extraction as cash for you, and we can borrow, depending on your serviceability. We've got lenders that we can get up to $1 million cash out for, a purpose that's acceptable to the lender. So non-structural renovations like bathrooms and kitchens, absolutely fine. You can control the money. You can pay your contractors yourself. You can do it down the track if you don't want to do it all now. But when we've got available equity, because we get a valuation that allows us to get that cash out, we would absolutely be wanting you to take advantage of that.
So a lot of questions did come through about construction lending, and you can borrow for the end value of a renovation. Now, the only difference is, Mel was talking about you can get cash out for renovations. That's if you've got the equity now. It's important to note that if you are looking to look at what the property's worth when the renovation's completed, let's say with that kitchen and bathroom and deck, my house has gone from being worth 600,000 to 700,000, and I need the valuation of 700,000 to be able to have sufficient equity. I need a fixed price contract.
You do, absolutely.
Because the bank has to value it as it is complete, and then they want to control that.
They do, yeah, absolutely. So we would order a valuation as if complete. So they basically use the contract and plans, and the quantity surveyors with the valuers. They would come up with the price of what the property's worth. Generally it would just be the cost plus what it is worth now, but some may actually be adding like quite good value to your property, and that's the value that we would rest the actual refinance or renovation money out from.
Yeah. Now, just to cover off what the issue is, so some people have said, I'm having trouble getting a fixed price contract. Now, builders have had some problems with the cost of building increases. There's been a lot of changes. A lot of builders have gone under because they have been giving fixed price contracts, and then the cost of building goes up. So some people when the bank says, I need a fixed price contract, and then your builder says, I won't give you a fixed price contract. We're only going to give you a cost plus contract, which is becoming more and more popular. That's where you get a stalemate. The bank says, I'm not going to lend it to you without a fixed price contract.
Yep.
And then the builder goes, well, I'm not giving you a fixed price contract, because if the cost of building goes up, we're going to be the ones losing out. So that's where you kind of need to have the equity in your home now to be able to do it.
Absolutely.
One of the questions that came through said, if I want to use the equity in a home I have to do renovations on another home, can I do that? You absolutely can, because when you're borrowing for construction purposes, some of the bank want to control the funding, but if they're not changing the security they're holding, absolutely you can.
That's right.
So you can get cash out of up to $1 million.
Up to $1 million.
And especially if you're not changing the property that they're doing. But if you're going to knock walls down of a property that the bank holds as security, that's the time where they're saying, well, if you're going to knock the walls down of the house that we hold as security, we want to make sure you finish.
That's right. Well, and they want to make sure too that the property is going to be worth, you know, you're not changing from a 5-bedroom home to a 3-bedroom home.
Yeah.
You know, they want to make sure they've still got an equitable property at the end of it.
Yeah. So we covered off. So using money for, I guess, renovations, which is popular.
Yes.
I mean, if it was a caravan, that's going to be exactly the same process.
Don't buy a caravan.
Well, we did a lot of caravans in COVID.
We did do a lot of caravans.
And you can, like, if you've got 100,000 equity in your home, usable equity, and you can cover that income, if you want to go and buy a caravan, that's your prerogative.
Yeah.
And a lot of people did that, and they took off in COVID.
They certainly did. I love them.
Now, what about if I'm doing that for investment? So can you explain to me the difference if I was going to take that equity out for investment purposes?
Yeah, so that's an acceptable purpose for the lender. So generally how that would look is that there would be a separate split on your home loan for this investment purpose. Generally, it would be an interest-only split. So if you're not using the money right now, you're actually not going to make any repayments on it. And if you're not sure whether you're actually going to buy a property yet, or you're not committed to the purchase just yet, and we don't need income from a prospective purchase, to service the loan, then we can just do it as a separate split, the same as the equity release for your renovations or for your caravan, exactly the same thing. And it can just sit there. You don't have to make a payment on it. Just use it when you're ready. Yeah.
So if I needed to use the rental income from the property, then I'd have to give you the contract of sale of the property I was buying. But if I can afford the deposit and costs before I find a property, I can just get the deposit and costs out for the proposed purchase.
Absolutely.
Separate split, whack it against my own home.
Absolutely.
And then I'm waiting for a property. What if I don't find a property?
Then it can just sit there. Or
I'm not paying for it.
You're not paying for it. No, exactly. I've got some clients that have ended up buying shares instead of buying an investment property, because for them that strategy worked better.
Did they have to inform the bank of the difference?
No, they did not.
Yeah. That's interesting. So if it's investment property, so I think some people get confused with the fact that it's secured against your own home.
Yeah.
And that's where you've got to say to your accountant, this is my home loan secured against my own home. This is the investment loan secured against my own home, but it's for investment purposes.
Exactly.
So from an accountant's perspective, it doesn't matter what the loan's secured against, it matters what the purpose is. So it could be secured against your own home, but it can still be tax deductible for your investment property.
Exactly. Yeah.
Yeah.
That's exactly right.
So last thing about using equity is consolidating debt. So touching back on what we're talking about for affordability, I think a lot of people have found themselves stretched with the rates going up. They've gone and gotten some sort of personal debt. And now with the personal debt and their home loan, rates have gone up and things are getting tough. A lot of these people have gone to their banks and been told they don't service their lending that they have. Tell me how I go about consolidating these debts.
Yeah. So with a refinance, we can do debt consolidation. That's absolutely fine. And generally that increases your borrowing capacity because we're taking away the repayment for a shorter term debt. So things like HEX repayments, that can be an absolute killer for some clients reaching the goal of, what they need to borrow. And that can be, we can roll that into a refinance.
If there's sufficient equity.
As long as there's sufficient equity, absolutely we can do it. If you're not sure that you want to close it, or even if you've got cash to pay those debts off, we can get approvals from the bank subject to things being closed. So it doesn't have to be something that has to happen straight away. We can make sure that the bank's happy to take your deal in the first place.
And I think that's a really good point about the fact you don't need to do it now. No. So people talk about, I've got a help debt, I've got a credit card, I've got this. What do I pay out to be able to do these things? I think the best advice is to get the scenarios broken down each way before you do a single thing. If you don't know what you can borrow without having that help debt, why put your cash into the help debt until you understand what you're doing?
Exactly.
So a broker like Mel will give you the scenarios all the ways, and then you can choose what's best for you with all of the information in front of you.
Absolutely. And you'd be surprised at the difference that, credit cards and personal loans can make to your borrowing capacity. We can do the scenarios. If you reduce the limit on a credit card or paid something out, this is what it would look like for you.
And when we were doing debt consolidation, when rates were really low, I would always encourage the team to, let's say it was a $50,000 car loan that was getting refinanced in, and it was a 4-year loan term left on that car loan. Now, you don't want to roll a 4-year loan term out to 30 years because you're going to pay a lot more interest over the time. But we would go, well, let's get it to home loan rates, but make it a 4-year term and do a separate split. Now, with the rates the way they are now, sometimes you can't do the 4-year loan term because you can't afford it on paper, but there's nothing stopping you paying more. So you might go, I'm going to do it over 30 years and have Mel say, well, this is what the repayment would be if you paid it over 4 years, and just increase your repayment to make sure that you're still paying it off in 4 years' time.
Absolutely. Yeah. But, at these times at the moment, like majority of the clients' goal is to reduce their repayments, and that's out.
It's not about getting ahead.
It's not about getting ahead right now. It's about keeping your head afloat and making sure that, your life, you can maintain the lifestyle that you like to lead. But there's some simple things that we can do that, can make such a huge difference. The, huge $1,000 car repayment can be reduced down to like $20 a week. Like it's massive, the difference that it can make on a refinance of those debts.
Yeah. And I think as long as people understand what it means. So as long as you understand, look, I'm reducing my repayment now, but if I don't pay any extra, I'm going to pay this much more interest over the life of the loan.
Exactly.
I mean, there'd have to be it still might be the way, well, I'm actually going to be able to keep my house.
That's exactly right. And your house that you're in now may be worth, 10 or 15% more in the next few years if you're able to hold it for that little bit extra.
Yeah. So we've covered off consolidating debts. Now, you mentioned valuations and getting multiple valuations before.
Yes.
Valuations are such an important thing because they allow you, I guess, the usable equities up and down. But it's also about rate. So tell us how the valuation can affect the rate of your home loan.
Yeah, so the lenders all base their rate off the risk rating, basically. So what your loan to your value ratio is of your property, it's called tiered lending, basically. So anything that's, if you owe less than 60% of your property value, your rate is going to be much better than someone that's got a 63% lend. Or
depending on how negotiating, how good you're negotiating.
Depending on how good your broker is. And same, like if you owe 79% of the property value, your rate is different. So that's really important that we do valuations across a range of lenders. It ranges dramatically. So I just had a client in Victoria who had, I did 5 valuations for him across a range of lenders, and his valuations range from $990 to $1.3 million. Now that's massive.
$400,000.
It is massive. Yeah, massive. And he was wanting to extract some equity, get a lower rate, and the lender he ended up going with, which was the highest valuation, surprisingly, the rate was actually the lowest as well. So he won on both levels. So, and that was completely free for him to do. So it takes a little bit of time for us to do that little bit of the legwork before we get to an application. And it's really important that we do it properly, and that you're given all the options. So, if it means, if getting more money out of your property is more important to you than a lower rate, then that's fine, but we cover all bases for you.
Yeah. And I think before, when people say, what would the rate be? I think you need to know the valuation before that.
Absolutely.
Because, if you get a really good valuation at a particular lender, that can really drive that rate when you're negotiating.
Absolutely.
But again, more often than not, is it going to help you reach your objective? Are you going to be able to refinance at all?
Exactly. And a lot of the times that first initial chat that we have with clients, we're talking about how much they owe, what they think their property's worth, when was the last time they had someone look at it, or when they bought it, so we get a good gear as to whether they're maybe at the right level with the valuation, and then we can just take it from there and have a look at what it actually is worth.
Actually, when we talk about valuations, I just want to touch on something of what a valuation is, because when you can go onto our website and get a property report, and that's when you get a real estate valuation. They're looking at the data of what's sold, and they give you a property report, an estimate of what that property is worth. You can go on our website anytime and you can get a free property report. That's not what we're talking about. For a valuation, it has to be a bank will send a valuer to your house. It might be them, they might use a computer val, they might use a drive-by, but it has to be done for their purposes for it to be considered a bank valuation.
That's right.
Now, I can't take an ANZ valuation and use it at Commonwealth Bank.
No.
If Commonwealth Bank has the highest valuation and the highest valuation is important, we need to go to Commonwealth Bank.
Absolutely. Yep.
Luckily, Mel can probably negotiate as good a rate at Commonwealth Bank as she can anywhere else.
Absolutely. Yeah.
So it's not going to rates are similar. I think the valuations are really important before we start to talk about anything.
Yeah, absolutely. And it just gives us a good gear of, what is that available equity that we've got to be able to do the things you want to do.
That's right. So we've talked about valuations, we've talked about rate. Let's assume they're all the same. If I come to you for a refinance and everyone's valuing it the same, the rates are all pretty similar, what are the things that you think I should be looking for in a lender?
Yeah, so there's a lot of different things, obviously, that make a good lender. For some clients, it's customer service. It might be having a branch. A lot of the time, it's the way their product is structured. So products that have offset accounts, or a offset account, or multiple offset accounts. It's different across every lender. We've got most of those come with an annual fee. There's basic types of products that have no annual fee, which we're doing more and more of.
Yeah, I've actually noticed that. We do a meeting every month and we see a split of the product type. And I noticed in the refinance product, basic was about 30% higher than it's ever been across our business. And I think that's because people are looking at the annual fee with a product that has offset and all of those things, and what they've got less cash now. They've got less disposable cash.
That's right.
So they're going, well, I'm going to go that basic product because I don't have all that spare cash rolling around. So I don't get the benefit that I used to.
They're not going to get not going to get the offset benefit. They don't want to have to spend that extra $400 a year on the annual fee. And some of the lenders have actually bought out a product on a basic product where you can have the option of an offset account, and it's just a monthly fee. So say for $10 a month, you can have an offset account if you feel that if we also feel that you'll get benefit from an offset. But that's $120 a year compared to $400, which is it's a lot of money.
Yeah, I actually put a diehard offset fan into a basic product, a multiple investor, because they just decided not to have those fees anymore, and the rates were a tiny little bit less. And I always thought they were going to be offset clients, but they went for it because I guess with a lot of those basic products, you've got redraw, and it's you can put money in and out all the time.
Exactly. And the benefit of redraw is exactly the same as offset. It's just offset, you just don't have to think about it because you can transact on it. It just does its own thing. Redraw, you just have to physically move the money. So it's a great way to still save interest. But again, we're in a time when people don't have spare cash laying around to be, offsetting their home loan at 100%. Huge rates at the moment anyway.
That's right. So, and I guess another thing that I would look for if I was recommending a lender would be my ability for my team to reprice your loan post-settlement. I think that's one of the biggest things that we do.
Yeah.
And if a bank, let's say Bank A and Bank B have the same rate or a similar rate, but I know Bank A is going to make it easier for my team to reprice you in 12 months' time, we're going to put that to you when we compare.
Absolutely.
And my biggest driver is, can I work with that bank long term? Yeah. Are they great? We've got a couple of banks that we work with that have a portal that we can go into and reprice. If they're giving new customers better rates, we'll go in and reprice our existing customers. Yep. And some banks make us jump through a lot more hoops to get that for the same customer.
Some banks don't even let us talk to them in terms of getting a better rate for them. And they're the types of lenders that we tell our clients up front that we don't have the power with that lender ongoing to keep negotiating a rate for you. You're physically going to have to ring that bank, and we don't want the clients to have to do that. That's what our job is. But generally those banks are the ones too that don't have the great customer service as well. So and that's another thing, goes back to what are people looking for in a lender? Like, if you want a bank that's going to look after you holistically, they're probably not the guys that you're after.
And before we move into questions, and I've got some to answer here, I've got some probably on screen, I just want to put it out there that if you reach out to the Sphere team and they can reprice you with your existing lender, whether we get the business or not, we're happy to help.
Absolutely.
I have seen the team work through clients, helping them on discharges. They can't refinance them, but they're on the phone saying, this is what we need to say, this is what we need to do. If you want help repricing your loan and you come to us, we will help you. Generally, you'll be a customer of ours one day anyway. So we're more than happy to help if you're just trying to reprice with your current lender. So I'm going to move on to questions. I have a few here. If we don't get to your question, if you reach out to us at hello@spherehomeloans.com.au, someone will come back and answer your question. I think that if anything's quite specific, the best thing you can do is on that same email address, book in a 15-minute chat with Mel. We never charge for a consultation of any sort or anything along the way, but a 15-minute chat, you don't need to give us all your information in writing, just a verbal. Mel can just give you a bit of a clarity chat. So 15 minutes just to answer a lot of those questions, especially if they are quite specific. But I'm going to kick off with a few questions that we have. I'm going to answer the one on the screen first, which says, if you are on an interest-only mortgage for investment, when the term ends, does the interest paid count towards the loan term? So what happens is, if you do a 30-year loan term and then you do 5 years interest only, at the end of that 5 years interest only term, the product actually rolls over to 25 years principal and interest. So the repayments would be more after that 5-year term than they would be if you paid principal and interest the whole time, because you're doing a loan term over 25 rather than 30. Now, most people, and traditionally, you get to the end of that 5-year loan term and you roll it over and you do interest only again. And before the Royal Commission and a few little responsible lending came in, it was a phone call to the bank and we could just roll over interest only. I've got clients that I've done loans for 10 years ago that I did 15 years interest only for. We don't even have to check those for 5 more years. But right now, everything is different. So it's a full assessment to change back to interest only. So you get to the end of the 5-year interest only term and it's a full credit assessment to be able to go back to interest only. So if you can't refinance, if you can't roll it back to interest only, then you're going to be paying more than if you started paying principal and interest at the start. So I hope that answers your question. If it doesn't, please reach out. Lee asks, I would love to hear more about that we actually answered that question before, sorry. Darren asks, how can I refinance without it impacting my broker's commission or clawback period? That is very thoughtful, Darren, but I would say that I would not be concerned about that. If it's in your best interest to refinance, you should refinance whether it affects your broker or not. I would just suggest you go back to the broker that did your loan. That way they're going to get clawed back here, but they're going to get paid again. And sometimes we can't help it. Sometimes we have to.
Absolutely.
I would say I would try to recommend the right bank at the start so I didn't have to. But if you're in a bank that isn't playing ball and you need to refinance, go back to your same broker and ask them to refinance you.
Great advice.
Shannon?
So Shannon's got a few questions here.
There are 6 points from Shannon.
There are 6 points. So that's there's a lot. What's the best way to look good on paper when refinancing or looking for an equity release? Got 2 kids and the bank seems to see them in worse light than their actual day-to-day living costs, and assume that their living costs are higher than what they spend. So Shannon's asked if she should leave out things like daycare costs from her fact find with us, and also that the bank's not taking in the tax deductions on negative gearing on an investment property. That's right. So yes, some banks do not take negative gearing at all. So some just don't do it really well. Some do it really well. And again, that varies across every lender. In terms of your costs of daycare, don't leave them out because they are a cost.
They're a cost.
And generally, the bank has a income living expense threshold. It's called the Henderson Poverty Index that they set for clients. And if you don't spend as much in your budget, and a lot of clients don't, as what the bank's going to apply, they're going to apply it anyway. That's just the way the banks do it, and they've been set that for responsible lending. But things like daycare costs, they are, they're ongoing costs. We do have some lenders that actually include them within that Henderson poverty.
I was thinking
HEM expense.
Sometimes they put daycare in a different column.
Exactly.
That lender may be a little bit more beneficial for you.
Exactly. And they do that for things like private health insurance as well. Yeah.
So super contributions, when the bank is assessing loan for servicing, how are super salary sacrifice contributions seen? Should I pause them before I apply for a loan? I would say no to that, because even if you're doing extra super and we can say that it's voluntary, there's no need to stop it. We can just tell the bank that it's voluntary. So I wouldn't go around making changes like that. And I'm actually looking at a few of these other points, like, should I close my credit card? I wouldn't close your credit card. I would get the scenarios done
absolutely
both ways first.
Chat with us first.
And a lot of the time you can get a pre-approval subject to the closures.
Oh, 100%. Yeah. So if it's something that we know that, is going to, increase your lending or something like that, we don't want you to go and spend your money paying out a credit card right now. We'd rather us get an approval in place with the subject of that approval being the card closes. Once we've got the approval, you can go ahead and close it. But don't do anything yet.
So how does one calculate savings for money held in an offset account as opposed to being held in a savings interest account? Now, it really doesn't make any difference from the bank's perspective whether those funds are in an offset account or an interest savings account. But the difference for you, Shannon, would be if it's in an interest account, you might be getting, 4% interest on your money, and you'd be paying tax on that money. If it's in an offset account and your home loan rate 6%, you're basically getting 6% tax free. So I would always say, if you've got a home loan, it's better to have that money in an offset account than an interest bearing savings account. But it's no different from the bank's perspective. When you're getting assessed for a mortgage, the bank doesn't mind where your funds are. It makes absolutely no difference to your assessment.
None at all. No. What's the process for a knockdown and rebuild on an owner-occupied property, and what considerations need to be made if you already have an equity release on the property and you intend to knock it down? That's a really good question.
That is.
That's quite a complex question, actually.
It is. So I guess one of the important things is people want to do knockdown rebuilds, and we do those a lot. But I guess I have done more scenarios for clients wanting to do a knockdown rebuild where they've opted not
to do it. Yeah.
So when you look at the property of what you've got now, let's say you've got a house worth 900,000 and the land component is 700 and the build component's 200. I'm saying it's 200 because you're going to knock it down. I'm going to assume it's not, an older style home. But when you knock down that house, all you've got is land value, and then you have to buy a whole new build.
That's right.
So for some people, that's great, and there's two that do it successfully. But a lot of the time we break that down for a customer, and they realize they're losing all of that equity of the property.
That's right.
They tend to sell and rebuy. Now, an outlier for that would be a reason they wouldn't do that is they really want to be in the neighborhood, or their land is particularly thing. But the process is to get a valuation of the land. Then you get what you're going to build, you get a fixed price contract for, and it's a construction loan. So it's really just like a normal construction process, except we have to allow funds for the knockdown as well. Now, when anybody's doing a knockdown rebuild, I would always say to get as much cash out as you can first.
Absolutely.
Because the bank will only fund what's in the fixed price contract. And I think with a knockdown rebuild more than a normal build, there's more out of contract items that you need to allow for, like council approval for certain things, architecture plans,
removal of
debris and knockdown. So a lot of the time you get say you've got your land now, you get an equity release now then you fund the fixed price contract later. But I think the best thing to do is get a scenario based on how that would look before you start process one.
Yes, please don't. Don't knock the house down and then come and see.
And I wouldn't even spend the money getting council approval or architecture plans, which a lot of people do first.
They do, yeah.
I would want to see it all broken down in a scenario beforehand, before you make step one. Let's break it down all the ways of what the process is.
Absolutely.
Each way. And then if you're doing it back here, you've still got a chance to get the cash out. Where if you've knocked down your house, you might be less likely to be able to get the cash that you need to finish.
Exactly. And all those approvals all cost money, and we don't want you but throwing your money away if it's something that's not going to work.
Yeah. But the steps are get the valuations, get a pre-approval first, and then everything else goes after that.
Absolutely. Yeah.
So this is a good one. What occupations waive lenders' mortgage insurance? They're a teacher and a professional firefighter. And is LMI waived for investment loans or owner-occupied loans?
Yep. So that's a really good question. And yeah, absolutely. We've got LMI waivers for teachers, and it's both on investment and owner-occupied properties. So there's definitely options out there for them.
Yeah, great. So I think a lot of people aren't aware of the LMI waivers. So if you are a registered nurse, a podiatrist, an accountant, there's a whole list of industries that qualify. When we talk 80% without mortgage insurance, you go to 90% without mortgage insurance and 95% for some medical professionals.
That's right.
So that isn't just on your own occupied property, that is on your investment properties as well. So whether it's refinancing or buying, you can go to 90%, and that makes a huge difference.
Absolutely.
Some people are with a bank that maybe you don't need. Maybe you're buying at 80% when you bought your first house, so you didn't think about this at the time, and your bank says, oh, we don't do that. Well, that doesn't mean other banks don't.
No.
So I would always look at and I would actually recommend that at the start. So if somebody didn't need an industry professional bank, but they were in that industry, you still want to put them with a bank that does it.
Absolutely.
So when they do want to do something down this track, like a knockdown rebuild, they're using 90% instead of 80%.
Absolutely. Yeah. And you can extract the cash out of your current property up to 90% to put towards that next purchase, which might also be at 90%. It's a huge saving for those clients.
Yeah. So always check out if you're an industry professional, if you've got one of those industries, and a lot more on that list than was once upon a time.
We have a lot.
So always check it out. All the banks differ for that. Just on that, when we talk about the LMI waivers, there are some banks that do no mortgage insurance for all industries up to 85% as well. Exactly, so it's really important. A lot of people think I'm 82 or 83%. There were a lot of questions that came through about if my property's not worth as much. Now, can I still refinance? Well, even if you're at 83%, it doesn't mean you have to pay mortgage insurance. It just means let's go to a lender that won't charge you mortgage insurance.
Exactly. And that works really well for clients like kids that have used their parents as guarantors, and we're almost there to be able to release them. But, if we did it now, they would incur mortgage insurance at some lenders, and the whole idea of having the guarantor was not paying mortgage insurance. But we do have those lenders that go to 85, and it's a nice little bracket for clients that are just not quite there.
That was a huge amount of our refinances this year too, was releasing parental guarantees, because everyone had all that magical equity rise.
Yeah, exactly. And also the first home guarantee, removing the government from clients' properties.
That's a big one. So Marissa asks, my partner and I bought our first property in mid-21 in Newcastle. We are on a variable rate and hoping to refinance early next year before I go on maternity leave. I'm wondering what happens if we refinance our property and our property is worth less than what we paid. So I think I'm going to start off with that I think the best thing you can do if you're worried about something is to take your head out of the sand, don't ostrich, face it head on and get the valuations done. Reach out to Mel, get her to order some valuations, and then you're not guessing or stressing about what that valuation is. You might find that, yes, it's less with one and more with another, but even if it is less than what you paid, it doesn't necessarily mean you can't do anything.
No, that's exactly right.
We just have to work with the valuations we have.
That's right.
No one comes out and says you can't do anything. Like if your house is worth less now, you might not be able to refinance, but they're not going to come back, and if the valuation comes back
the bank
lower,
can't recall
anything. They can't do anything retrospectively if your valuation goes down.
Exactly. And those valuations last for 6 months that we can do up front. And again, we do multiple ones. If we're worried about what your loan to value ratio is going to be, let's do lots of valuations and just see where we're at, and do it before you go on maternity leave so that we can have a look at the scenario for you. But again, even when you're on maternity leave, we still can refinance you. We've got lenders that take your return to work income.
So even if for some reason you can't do anything until you are on maternity leave, just remember there are banks out there that do use maternity return to work income. income
That's right.
or what you will be on when you return to work. I would just face that head on and see if you can refinance, and also work out what you want to refinance for.
Yeah,
so a lot of people, when they say they want to refinance, is for rate.
Yeah,
maybe we just need to reprice you rather than refinance.
100%. Yeah, maybe it is that we keep you at the same lender that you're at, but we just negotiate a better rate for you.
Yeah, and if you want to extend your loan term out for some particular reason, you can do that with an internal refinance. So we can still keep you with the same bank if you want to, and still extend that loan term out.
Absolutely. Dana asks, is it best to pay more on your loan while it's in a low fixed rate, or be cash heavy to prepare for the end of your fixed rate? Well, that's kind of works out either or, really. If you're paying extra off your home loan while it's in a fixed rate, you've just got to watch that you don't pay more than what it's usually $10,000 a year, your cap that you can pay off that property. And that can sit there, yes, as extra cash for when we're ready to refinance you, when you roll out. But a lot of our clients that we've helped prepare for their fixed rate roll off is that we've set their repayments for them now for what it's going to be when they do roll off. And they're not paying it to the loan, but they're paying it to the offset account. Yeah. And then they build up a buffer in that offset account. And they can use that to help pay the repayments when they roll off, to make things a little bit easier, but also just to prepare them for paying that little bit extra.
Yeah, and some banks do have offset on fixed loans.
They do, absolutely.
So if you're something that has an offset account, absolutely, I'd stick it in the offset. But if you don't have offset, I'd be inclined to pay it onto the loan, because if it's just in a savings account, it's not going to be making any money for you at all.
No.
But don't go over that maximum payment that you can pay.
That's exactly right.
Someone's asked because we mentioned that there were the refinance rebates. We're going, if there's still banks paying rebates for if I do refinance, because it can cost, I guess it can cost money to refinance.
It does, yeah.
Generally it costs under $1,000, but the rebates there, I guess, to entice you to do it.
Yeah.
So what is anyone still offering a refinance?
Yeah, we still have a few lenders that are offering around 2,000. We have one that's offering a little bit more, but the value of your loan's got to be significantly higher. I think it's around $750 for that lender, but generally it's around $2,000. There's only 3 left that are doing it. Not a lot. But I suppose if we're saving you some on your rate, we're extending your loan term, and we can get you some cash back, then obviously those first 2 to 3 years are going to look a lot better by going to one of those lenders. Yeah, great.
And I think I was never a fan of the cash back, because I think it entices people to move around, and I guess, and it stops banks doing what I feel like they should do, which is trying to retain their customers.
Yeah.
Like, I would much prefer to put somebody with a bank that they're going to be put somebody with a lender that they're going to be happy with long term.
Absolutely, yeah.
And leave them there and just keep working with them with that bank, because if you're changing all the time, it can get frustrating, especially when people offset so great to use, but if you're not moving your offset and all of your banking all the time, it can be more costly.
Oh, it can be, and it's inconvenient too. Like, I've just done it, and it's not easy, just like changing all your direct debits and everything like that, and to have to keep doing that multiple times. You just got to think about the reason as to why you're refinancing.
Yeah, and that's the thing, why you're refinancing. So I think when you come and see a broker about a potential reprice, refinance, what it is, we're going to I guess we're going to look at your short and long-term goals and go, well, why are you doing this? And we do something called a credit proposal. And in that proposal, we cover off all those things that say, because we have to work in your best interest, we're covered by law to do so.
That's right.
And we show you how we do that. So we might say, short and long-term goals, this is why you're doing things. And a lot of the time, when we sit down with people that want to refinance, it's not in their best interest to refi. But if you are refinanced for a particular reason and going to a particular bank, all of that will be outlined in the credit proposal.
Yeah.
And that says, I'm going to be extending my loan term out. What does that actually mean? And we'll cover off how much more interest you'll pay over the time. Like, you need to know all of that before you make any decision regarding your finances. I feel like you need to be informed. And that's where I think the information, the credit proposal is so important. And even the scenarios that go back and forth.
Absolutely. Yeah. You want to be able to make an informed choice at the end of the day. And, we don't want to have to refinance you in 12 months time, because we want you happy at the lender that you're going to. We don't want to have to be moving you all the time, because it is an inconvenience to you. And, it's paperwork that you have to give us all the time. So it's really important that we set those goals from the start. Quite often we see some clients that have gone to a really cheap lender maybe 12 months ago, but they always had the intention, not with us, but they had an intention of buying an investment property. Now they've gone back to their original lender and they can't borrow the money that they need to for that investment purchase. But, some of our lenders may be hundreds of $1,000s more that they can borrow because of the way their calculators work.
Yeah, that's a huge difference.
Huge, yeah.
So Nat asked, what is the typical rate at the moment for an owner-occupied home with an LVR of 80%, a loan amount of about $500,000?
Yep.
I think you're the best person to answer that, Mel.
Yeah, so if 614 to 624 would probably be the majority of the lenders. They're all very, very similar at the moment. There's not much between them. We did have a couple of lenders that were a fair bit lower that. They were in the 5s, but they've just snuck their rates up. So they were one of those lenders that dangle the carrot and make their rate look really good, and then all of a sudden
they jack
their rate up. And clients are warned of this beforehand, obviously, because we know what they do. But yeah, generally around 614 to 624.
So let's say 614 for a decent bank that you don't think is going to jack their rate up.
Yep. Yeah, that would be like probably the top 5 of our lenders that we see clients choose the most.
Yeah. Now I think if anyone's a 6.1, 6.2, even 6.3, I probably would go, I want a fairly decent rate.
Yep.
And I don't know whether I'd refinance at 6.2 because I can get 6.14.
Yes.
If my loan was $3 million, I might.
Absolutely.
But at 500,000, I think there'd have to be you're not going to refinance for $400 savings a year.
No, not
if you're just doing it for rate.
That's right, exactly. So that's why it's important that we go back to that loan term. If we're looking to just reduce your repayments, then we need to be looking at loan term more so. And when we do our proposals to our clients with the comparisons against lenders, it'll show you what the difference of the lenders across 3 years and then across 30 years. And you can see the difference in the rate, which might be very minimal, but maybe the fees that the banks charge or any cash back that are in there, it'll show you exactly where you're saving that money. And also the repayments differ across those lenders.
Yeah, we actually had a huge amount of clients come through last week. I did John, Glenn and I did a podcast on just a property recap, and we mentioned things about, if your rate started with a 7 to reach out to the team, and it was amazing how many people were on 7s.
Yeah, it's scary, actually.
And they just crept up. So I'm going to explain what happened there of why all these people were on 7% when we're talking that rates should be in the early 6s. Now, your bank went up 0.25 13 times, and they all did. But what happened was, and this is the sneaky thing that banks do, they put their rate up 0.25, but then they increase the discount for new business, but then don't tell anyone.
No.
So what our pricing team does is they look around and go, well, this is the rate that you can get now with that bank. And as soon as there's an ability to reprice, we go in and reprice our book.
That's right.
At that bank. So I think that if your rate starts with 6.5, you would reach out. If your rate starts at 7%, there's no question, you need to
100%
absolutely talk to a broker. Even if it's not us, talk to a broker.
Yep.
Go to a broker and get a review.
Absolutely, yeah.
Even if it's 6.5, but 7% is horrendous.
That is, for investment, that's horrendous. Like if you've got an own occupied property and you're at 7, you definitely need to be doing something.
Yeah.
Yeah.
Now, we are just about out of time, and I think that we've gotten through just about all of the questions. If we did not get to your question, please reach out to us, hello@spherehomeloans.com.au. Mel would love to come back and answer any of your questions. And if you've got anything you think of later, please reach out. But thank you for joining us, everybody.
Thanks, guys.
And we will talk to you soon.
See ya.